Welcome back to your Mortgage Insider Update for this week. We are recovering after last week's CPI report came out a little hotter. It actually came down month over month, but in year over year, just not as much as expected. A lot of that having to do with just nagging inflation or a lack of catch-up in owner's equivalent rent, the cost of housing, as prices have stayed elevated. We've seen continued inflation reports with higher inflation costs as a result, right? Households cost more to buy a house, financing's expensive, but that inflation seems to be slowing down, and we're hopeful that as we get into the spring months, a few more inflation reports we'll get past this March time period where the Fed's not going to be cutting rates in March. It's pretty obvious now. Looking more like summertime at the very earliest. The Fed still projects that they're going to have 3 cuts by the end of the year. So if they started in the summertime, they could get that done in the back half of the year. The markets were anticipating a lot more than that. Unfortunately, we're not getting it quite yet. So let's see the result from last week's pullback on rates. So today we have the 10-year Treasury down 3 basis points, which is positive, but notice we're at 4.25% on the rate. Mortgage-backed securities are also in the green. They're positive today. We'll take a look at those next. But what we're looking at on the result of last week's CPI report is this large candle where we lost a lot of ground and interest rates went up, hit above this 100-day average, and have settled there. So we had our lock alert last week. We see trending better than it could be, right? We could be a lot worse. There's a lot of room higher if we go above the 100-day average. Right now, stuck between the middle. It'll be another couple weeks before we get any major reports that can help us offset this and bring interest rates back down to a level we saw in previous weeks, that mainly being the PCE report that comes out at the very end of February. When we look at the mortgage-backed security, prices are higher. Higher is green is good in this case. The price of the bond costs more to investors. That's bouncing off the 200-day average. The opposite from last week. We had our CPI report pulled this way down. We've settled, and right now, best we can do is tread water and just accept that interest rates have moved back up into that 7% range, which we saw back at the back part of November and into December last year. We're back to those rates right now. We'll come back at you next week with more news and the Mortgage Insider Update. Have a great week.